The current live price for Beyond Meat Inc., trading on the NASDAQ under the ticker BYND, stands at $1.41.11 as of 12:56 p.m. Eastern Time on November 13, 2025, reflecting a sharp intraday decline of approximately minus $0.0739 or minus 6.63%. Now, most investors looking at Beyond Meat stock today see that sharp drop and immediately think, here we go again, another disappointment following the recent Q3 earnings. They're right to feel that way, but the real story, the one that should force a deeper look, isn't the quarter's revenue miss. It's the fundamental reset of the company's balance sheet, which is a development that was both necessary and profoundly painful, creating a complex new risk profile that the average retail investor tracking the daily price movement is likely overlooking. The market narrative around Beyond Meat right now is one of near total pessimism. The widely held expectation is that the category is slowing, the initial hype has evaporated, and the company is simply running out of runway. Our reality, however, is that management has just executed a massive, highly dilutive, but arguably life-saving debt restructuring that, for better or worse, pushes the most immediate liquidity threat further into the distance, transforming the very nature of the stock's risk from an imminent default scenario to a long-term execution and demand problem. That distinction is critically important, and it's the tension between the recent meme stock-like volatility, fueled by short interest and retail chatter, and the cold, hard financial engineering that just took place that we need to analyze. The latest market activity for Beyond Meat stock is an emotional roller coaster tied directly to the aftermath of its Q3 2025 earnings release. On the surface, the headline figures were grim: a wider-than-expected adjusted loss of minus $0.47 per share, year-over-year revenue declining 13.3% to $70.2 million, and fourth-quarter revenue guidance projected between $60 and $65 million, which sits below the consensus forecast. The stock has been highly volatile in the days following the announcement, suffering double-digit percentage drops as investors digested the ongoing category headwinds. What's driving this volatility? First, you have institutional selling pressure combined with bearish analyst commentary. Mizuho, for instance, just slashed its price target to $1 while maintaining an underperform rating, explicitly citing weak demand. Second, the trading volume has been massive, a sign that the retail crowd, often trading through platforms like Robinhood stock trading and using self-investing strategies on their individual brokerage accounts, is heavily involved. The stock has a high short interest, meaning every sharp move down can attract speculative buying from those looking to bottom fish or engage in short-term momentum trades, and conversely, any sustained dip triggers panic selling. The key takeaway from the recent trading pattern is that the stock is behaving less like a consumer staples company and more like a deeply distressed, high-volatility financial instrument, a type of speculative instrument that often draws the attention of those interested in quick swings rather than long-term growth, which is a significant shift from its initial public offering days. Institutional activity over the past quarters reflects a deeply divided view on Beyond Meat's future. While major institutions like BlackRock and State Street have added shares, often due to index fund requirements or minor rebalancing, a significant number of firms have been sharply reducing their exposure. This is more evident in the active management space. For example, Millennium Management and Susquehanna International Group have aggressively cut their positions, demonstrating a clear lack of conviction in a near-term turnaround. The institutional selling pressure directly ties back to the company's inability to stabilize its gross margin, which contracted significantly to 10.3% in Q3 from 17.7% in the year-ago period. This decline stems from a combination of higher trade discounts, price reductions to try and stimulate sales in the U.S. retail channel, and a less favorable product mix. The simple truth is that while the gross profit was technically positive at $7.2 million, it was heavily offset by costs, including a $1.7 million expense related to ceasing operations in China. Now, let's step back and consider what Beyond Meat actually is beyond the stock ticker. The company's core business model is centered on developing and marketing plant-based meat substitutes, aiming to replicate the taste, texture, and nutritional value of animal-derived meat. Their main products, like the Beyond Burger and Beyond Beef, are sold across three primary channels: U.S. retail, U.S. food service, and international, both retail and food service. The general belief was that the shift to plant-based diets was an unstoppable societal trend, guaranteeing high growth. The reality has been far different. Over the last year, domestic retail and food service revenue have struggled significantly, with U.S. retail revenue down 18.4% year-over-year in Q3. This deceleration isn't just a Beyond Meat problem, it's a category problem. The high price point of plant-based meats, perceived concerns about the highly processed nature of the food, and the lack of a compelling value proposition compared to traditional meat, especially amidst inflationary pressures on consumers, have all contributed to softer demand. This brings us to the core of the expectation versus reality tension. The market expected a consumption recovery. The company delivered a balance sheet rescue. The $1.2 billion in zero-interest convertible notes due in 2027 was an existential threat. Management's recent financial restructuring was a desperate but necessary move. They exchanged that vast majority of notes for a combination of new secured notes that pay 7% interest and mature in 2030. And, critically, a massive issuance of new shares, hundreds of millions of new shares. This significantly dilutes existing shareholders. While the debt maturity has been extended and immediate liquidity concerns have been eased, the value of each existing share has been drastically reduced due to the flood of new shares. For anyone holding Beyond Meat stock for a significant period, this means their percentage ownership of the company's future profits, if the company ever achieves them, has been substantially cut. This is a classic distressed company move, trading shareholder value for survival runway. This is a factor any investor managing their holdings on platforms like Interactive Brokers Trading or Schwab Intelligent Portfolios must carefully factor into their risk modeling, because the capital structure has been fundamentally altered. Looking ahead, the future of Beyond Meat hinges on a handful of key catalysts and risk factors. The central opportunity is the company's aggressive cost-cutting plan. CEO Ethan Brown has stated they are pursuing further and sizable cost reductions with the aim to eventually restore gross margins to 30+%. The market is highly skeptical of the pace of this improvement, particularly TD Cowen, which openly questioned how achievable that margin target is given current trends. If Beyond Meat can execute a swift and successful operational overhaul, streamlining manufacturing, cutting logistics expenses, and reducing corporate overhead, it could potentially surprise the market as cost savings drop directly to the bottom line, mitigating some of the revenue pressure. Another potential catalyst is international growth. While U.S. sales have struggled, international food service revenue actually saw a modest increase of 2.3% in Q3, suggesting that some global markets may be more receptive or that the company's strategy is working better abroad. The most significant risk, however, remains the top line. The company is in a negative free cash flow position, burning through cash reserves, and the Q4 guidance signals that sales contraction is ongoing. The entire narrative of the plant-based meat sector has shifted from inevitable disruption to premium niche, and Beyond Meat has yet to demonstrate a clear path to generating sustained operating cash flow within this new reality. The high dilution from the debt swap means the company needs a massive, almost impossible increase in sales and margin to return the stock to its historical highs and justify a reasonable valuation for the now inflated share count. Furthermore, the competition is intensifying. Traditional meat processors are now developing their own alternatives, and cheaper, less processed options are entering the market, putting further pressure on pricing. For those who engage in online investing, whether using Fidelity, SoFi Invest, or another platform, the decision with Beyond Meat stock isn't about the company's product quality. It's about the extended runway from the debt deal is long enough for management to completely remake the operations and reignite a sputtering consumer category. This type of situation is precisely where the true difference between speculative trading and fundamental investment lies. Comment below with what you think is a more significant catalyst for BYND stock, a sustained demand recovery in the U.S. retail channel, or a dramatic successful execution of their cost-cutting plan that hits 30% gross margins. In summary, the expectation in the market right now is focused squarely on the terrible headline numbers, the widening losses, the declining sales, and the negative guidance. These are the immediate realities that caused today's sharp sell-off. But the deeper, more complex reality is that Beyond Meat has just completed a major financial heart transplant, the debt restructuring. This move